Welcome to Capital Link's Trending News webinar series. I'm Nicolas Bornozis, President of Capital Link, and today we have with us Dr. Loucas Barmparis, the President of Safe Bulkers. Our discussion will focus on company developments and strategy, as well as on the dry bulk sector developments and outlook. Listed on the New York Stock Exchange under the ticker symbol SB, Safe Bulkers is an international provider of marine transportation services for dry bulk cargoes. The company's current fleet includes 47 vessels in the water, with an average age of 10.3 years, plus an order book of 6 more new buildings. Before we begin our discussion, a quick reminder of the traditional disclaimer, which is portrayed in more detail on the opening slide. That this discussion is purely for informational and educational purposes, and as an additional disclosure, Capital Link has a great privilege to work with Safe Bulkers on investor relations. Now, let me start by saying that medium to long-term evolution of the dry bulk market is one of the topics that we would like to discuss. So, Loukas, can you please talk us a little bit about the prospects of the market going forward? In this particular area, I'd like to ask you 3 questions to make every topic more clear. First, on demand trends in terms of cargoes and routes. Second, on fleet supply, taking into consideration the fleet age, the order book, and scrapping. And the third one, on the impact of regulations and especially regarding emissions. So let's start with the first question on demand trends in terms of cargoes and trading routes. And I guess here we have to add geopolitics that play a role as well. So the floor is yours.
Thank you, Nicolas, for giving us this opportunity to have this presentation and discussion on the most recent events. Before I answer to your question, I would like to point out that shipping has inherent volatility, and there are several factors that influence the market. As a result, our management's effort is to maintain a resilient company, to be able to react timely in opportunities, and to create, of course, wealth for our shareholders. A few days earlier, we have announced our financial results, which present a company with ample liquidity exceeding 300 million, comfortable leverage of about 38%, and a fleet consisting of recently delivered new builds, eco ships of previous generations, and environmentally upgraded vessels, which can compete and get monetary and operational advantage compared to our peers. Now back to your question, because as we said, volatility will be with us forever. Geopolitical uncertainties, tariffs, trade war, actual war incidents are playing a significant role influencing the market. We all know that dry bulk demand is correlated to the global GDP. Tariffs and trade war were and are influencing the market indirectly through GDP, and there is some hope that the settlement with the trade agreements will ease this pressure. According to recent projections by IMF, GDP is expected to grow 2.9% in 2025 and 3% in 2026. Of course, one of the drivers, which also is a question mark, is the dry bulk commodities in China, and the expected slowdown of GDP in China itself, because presently the expectation for 2025 is 4.5%, and for 2026 is 4%, a little bit lower, due probably to the property sector and the deflationary pressures from overcapacity. Another point, of course, as we all know, is the actual war incidents which currently block the Red Sea route. Obviously, they affect the trade, increasing the distances traveled. As a result, the demand, just concluding this part, the demand we expect to grow up to 1% for 2025 and between 1 and 2% in 2026.
Thank you, Loukas. Now, let me go to the second question on fleet supply, and let's take into consideration the fleet age, the order book, and potential scrapping? What's going on in this area?
Yes. Look, the overall order book is in the dry bulk is substantial. It's 10.8% of the current fleet. The supply side is the effect of the supply side in the growth is 1.9% in 2025, and it is expected to increase to 2.6% in 2026. Overall, this means that the dry bulk supply-demand balance, as we have referred earlier, is weakened, both in 2025 and in 2026. Of course, the effect of regulations, especially the environmental regulations, the aging of the fleet, and the more intense vetting for older vessels will accelerate scrapping, squeezing gradually the supply.
Thank you. Loukas, you just opened the door to the third question. The regulations regarding emissions are playing a big role. So can you take us through this?
Look, presently we have a reality which is the fuel EU and the EU ETS, which is already applied. It creates costs for older and energy inefficient vessels. And as I said earlier, what we are trying to do in our company is to prepare to build a resilient company focusing on quality of our fleet. The fact that we have also ahead of us a new regulation which was adopted by the NYSE 83 and is expected to be ratified in October, what we name a GFS or Global Fuel Standard. This will represent a new era towards decarbonization if all these are ratified in the autumn. And this will increase the cost for of shipping after 2028, because GFS basically is a regulation similar to Fuel EU, but it will be applied globally, and as such, it will represent substantial costs towards decarbonization. What I need to say is that our company is well prepared for that, and we also have two dual fuel methanol ships which will be delivered in 2026 and to early 2027, which through the mechanism of pooling will be able to contribute and avoid penalties of all these regulations.
Loukas, we have just started addressing the next question I would like to ask you. You have repeatedly stated that the modernity and efficiency of your fleet is a competitive advantage. So can you take us through your fleet renewal and modernization initiatives, the environmental upgrades that you are implementing on your vessels, and why are all these constitute a competitive advantage?
Okay, I'll say a couple of things before. Since 2022, we have invested more than 650 million in new builds and in environmental investments. We have ordered 18 phase 3 new builds. We have taken delivery already of 12. We have sold 14 ships. We have 7 second-hand younger acquisitions. And of these vessels in the water, 11 are eco vessels of the past generation, and 26 have been upgraded. Now, why we are doing all these things? Our investments do not have only a theoretical basis. It is important to note that all our environmental investments have a relatively short payback period, reflected through fuel savings to premiums in charter rates. For example, a saving of 2 tons of HFO per day means 6 tons reduction of CO2. Of course, this is very positive for your carbon footprint. But on the other hand, the benefit in the charter hire exceeds 1,000 USD per day, meaning that basically you have a payback period of about a year for, let's say, for an investment of painting your vessel with low friction paints. Similarly, the question goes also to why you invest in a phase 3 vessels. And I would say that a phase 3 vessel, and we have recently checked the market, compared to a conventional vessel, the charter hire has about 2,500 difference per day. So, for example, you can charter a conventional vessel at 13,000 today, and a phase 3 vessel at $15.5 thousand per day today. This is a meaningful return on the additional investment. And not to mention that in any event, you need to renew your fleet. I mean, the global fleet is aging. We all know that. And we as a company cannot stay with ships that will go to 20, 22, 25 years old. We need to renew them. And of course, this is done in terms for the environment and also for the benefit and the increase of wealth of our shareholders.
Loukas, for those of our listeners who may not be aware, can you please describe what is a phase 3 vessel?
Yes, a phase 3 vessel represents a vessel which is designed to operate with 30% reduction in fuel consumption compared to the average vessel back in 2008. So IMO has introduced 3 phases on design level: phase 1, phase 2, and phase 3, meaning that each one of them represents 10%, 20%, and 30% reduction of the average level back in 2008. These 30% phase 3 vessels supposed to come into the water after 2025. But of course, we were one of the first that make orders back in 2020 and 2021. And we have already now in our books 12 such vessels and have ordered 6 more.
Thank you. Now, let's go to your broader capital allocation strategy. How do you prioritize among fleet renewal, debt reduction, dividends, and other shareholder return actions? I mean, your debt is very low, so you have a robust cash flow. How do you prioritize the capital allocation?
In Safe Bulkers, we want to achieve 3 things: comfortable leverage, which safeguards the company during low market periods; liquidity, which gives us the advantage of quick reaction during market corrections; and rewarding our shareholders. As a result, we streamline operational cash flows to investing in the new builds and to upgrading existing fleet, and of course, rewarding our shareholders. The average net debt per vessel, as reported in our financial results recently, was 9.1 million, with an average fleet age of 10.3 years. And we all know that the expected lifespan of a vessel is 25 years. So basically, we want to do all these 3 operations: comfortable liquidity, comfortable leverage, liquidity to react, and of course reward always as much as possible our shareholders.
But Loukas, your debt, your net leverage is quite low. So I guess right now you are directing a good portion of your cash flow into the fleet renewal and of course into shareholder returns. Can you please elaborate on your dividend policy?
Yes, Nicolas, in our quarterly press release last week about financials, we have declared a cash dividend of 5 cents per share, which basically represents a dividend yield of 5%. we have this dividend stable the past 15 quarters, which shows something and to our shareholders. And I need to mention that we are using our cash flows, our operational cash flows, to, of course, to reward our shareholders and to continue the investments in new builds and the upgrade of existing fleet in order to secure further operational earnings in the future years.
So, closing our discussion, why should investors consider Safe Bulkers today, and what differentiates Safe Bulkers from your other dry bulk peers?
Look, if I was an investor, I would choose a company with a renewed and upgraded fleet. And we have 46 vessels in the water, and out of those, 12 are already phase 3 vessels and 11 eco ships. A company with comfortable leverage and ample liquidity, and we spoke about that earlier. A company with a hands-on approach, with experienced management, with presence in the dry bulk sector for several years. We are in the dry bulk sector since 65. I mean, we were more than 65 years in the dry bulk sector, with a company that is able to create value during high and low markets. I think these are the basic concepts of our management. Presently, the NAV of our stock is compelling for someone to invest, and I would say that each investor can assess the market and see when is the right opportunity to invest.
Loukas, thank you very much. That concludes our discussion. I appreciate very much having you with us today and sharing your insight on the company and the sector. As a reminder to everybody that this webinar will be available to access upon demand on Capital Link's website at www.capitallinkwebinars.com and also on Capital Link's YouTube channel. So thank you very much to everybody for being with us, and thank you, Loukas, of course, for sharing your insight.
Thank you, Nicolas. Have a nice day.